In my long career as a professor and investor, I have received countless questions about how to achieve success in the financial markets. But few questions reveal as much about the current psychology of Wall Street as the one proposed for today's class: how to turn debt into money. I must be frank with you. This question, though popular, is dangerous. It is imbued with the spirit of speculation, not investment. It suggests that wealth can be conjured from nothing, that borrowed capital is a magic shortcut to prosperity. My philosophy, forged in the crucible of the Great Depression of 1929, teaches the exact opposite. I have seen, with my own eyes, empires built on the shifting sands of debt be swept away by the tide of reality. I have seen men who considered themselves financial geniuses reduced to ruin, not for choosing the wrong assets, but for using the wrong money, other people's money. Debt does not transform into money. Debt is an obligation. It is a fixed promise in an uncertain world. The speculator sees debt as leverage, a way to amplify his potential gains, foolishly ignoring that it amplifies, to the same extent, his potential losses. The intelligent investor, on the other hand, views debt through two lenses, both defensive. First, he sees it as a risk to be analyzed on a company's balance sheet. Second, he sees it as an asset to be bought, in the form of bonds or debentures, but only when offered at such a great discount that it provides a formidable margin of safety. The speculator asks, how can I use debt to get rich quickly? The investor asks, how does this debt affect the safety of my principal? And, is this debt security being offered at a price that protects me against loss? The greatest financial catastrophe of the 20th century was not caused merely by overvalued stocks, it was caused by overvalued stocks bought with borrowed money. Margin buying was the speculator's favorite tool. When the market turned, as it inevitably does, the brokers demanded their money back. Speculators were forced to sell their stocks at the worst possible moment, just to cover the debt, annihilating not only their profits but their original capital. Therefore, our class today will not be a manual on financial alchemy. I will not teach you tricks to transform obligations into easy wealth. That would be a disservice and a violation of every principle I uphold. Instead, we will do something far more valuable. We will dissect the nature of debt from the investor's point of view. We will learn to distinguish dangerous speculation with other people's capital from the prudent analysis of balance sheets and the purchase of bonds with a robust margin of safety. Our goal is not rapid wealth, it is the permanent safety of capital. This is the only trick that has stood the test of time. To understand the trap of debt, we must first understand what the modern financier calls leverage. It is a term from physics. A lever allows you to move a very heavy object with little force. On Wall Street, debt is the lever. The heavy object is a large volume of stocks or bonds. The little force is your own capital. The speculator is obsessed with this tool. If he has $1,000, he does not think about buying $1,000 in stocks. He thinks about how to use that $1,000 as collateral to borrow $9,000 and, thus, control $10,000 in stocks. Why? Because he is not focused on the value of the underlying business. He is focused on the price movement. If the $100 stock rises to $110, the investor who bought with his own money, $1,000, has made a 10% profit, or $100. He is satisfied. His principal is safe. But the speculator who used 10-to-1 leverage sees a different outcome. His $10,000 in stocks is now worth $11,000. He sells, pays back the $9,000 he owes, and is left with $2,000. He turned his original $1,000 into $2,000. He did not make a 10% profit, he made a 100% profit. He feels like a genius. He believes he has mastered the market. This is the siren song of leverage. It is the same song that echoed in the brokerage halls in 1928 and early 1929. Thousands of ordinary citizens, seduced by easy profits, opened margin accounts. They were playing the market with the broker's money. And, for a time, it worked splendidly. Graham pauses, his gaze becoming distant, remembering. But they forgot the most basic rule of financial physics: the lever works both ways. When the market inevitably corrected itself, when unsustainable optimism gave way to panic, that same mathematics inverted with brutal violence. Consider the same speculator. The $100 stock falls to $90. His $10,000 in stocks is now worth $9,000. The investor who used his own money has a 10% paper loss. He may feel uncomfortable, but if his original analysis of the company's value is correct, he does nothing. He waits. But the speculator? He receives a call. It is the broker. It is the margin call. The broker does not care about the intrinsic value of the company, he only cares about the value of his collateral. The collateral, the stocks, is now worth exactly what he is owed, $9,000. The broker demands his money back, or more collateral. The speculator has no more collateral. He is forced to sell his stocks for $9,000 to pay off the loan. The result? His original $1,000 is gone. Completely annihilated. A 10% drop in the market resulted in a 100% loss for him. This is the capital sin. It is not the loss. Loss is a possibility in any venture. The sin is putting oneself in a position where a temporary price fluctuation, a mere whim of Mr. Market, can cause a permanent and total loss of your capital. The intelligent investor, by definition, never puts himself in that position. He buys with his own capital. When Mr. Market, in his manic-depressive panic, offers absurdly low prices, the debt-free investor has the luxury of looking at his quote and saying, "What a fool. This company is worth far more. Perhaps I'll buy more." The leveraged speculator has no such option. He is forced to sell to Mr. Market at the very moment prices are lowest, solidifying his ruin. Debt, therefore, is the tool by which the speculator hands over his decision-making power to his creditor and to the market's panic. He becomes a slave to the ticker. Now, let us leave aside the speculator and his dangerous lever. Let us adopt the mindset of the prudent investor. The investor does not use debt, he analyzes it. And his primary tool for this is not the day's stock quote, but the company's balance sheet. The balance sheet is a snapshot of financial reality. It does not lie about obligations. In my practice, I have always taught that the analysis of a stock should begin the same way as the analysis of a bond, a debt obligation. The first question is not how much can this company grow, but rather, is this company safe? When I look at the liabilities, the obligations side, of a company, I am essentially acting as a banker. I am asking, would I lend money to this entity? And, as a shareholder, how risky is my position below all the creditors? Remember, gentlemen, the hierarchy is brutally clear in bankruptcy. The debt holders, creditors, bankers, bondholders, get paid first. The shareholder, the owner, only gets what is left over. If a company is overloaded with debt, the shareholder is the owner of a mirage. To assess this risk, I ask two fundamental questions. First, what is the size of the debt relative to what the company owns? Many modern analysts focus on the debt-to-earnings ratio. I prefer, first, a more solid measure, the ratio of debt to tangible net worth, the physical assets, the real capital. Imagine two grocery stores. Grocery A owns its building, its inventory, and $50,000 in the bank, all paid for. Its equity is solid. Grocery B has an identical building and the same inventory, but it financed 90% of everything with mortgages and bank loans. In a prosperous year, Grocery B might seem more efficient, as academics like to say, as its owner used little of his own capital. But then comes the winter. A recession. Sales drop 30%. Grocery A tightens its belt and survives. Grocery B, unable to pay the interest on its huge debts, sees the banker knock on its door. It goes bankrupt. As an investor, in which one would you prefer to be a partner? The answer is obvious. Companies with little debt survive the storms. Second, can the company afford its debt comfortably? Here, we look at the income statement. We analyze what I call interest coverage. The calculation is simple. how many times do the company's operating earnings, profit before interest and taxes, cover its annual interest expense? In my texts, I have always demanded a rigorous standard. For an industrial company, I would want to see earnings covering interest expenses at least 5 times, and not just in the last good year, but on average over the last 7 or 10 years. Why? Because the Great Depression taught me that profits are volatile. Profits can evaporate. Interest expenses, however, are fixed. They are like the incessant dripping of water. If a company in 2024 can barely cover its interest, say, 1.5x coverage, what will happen when Mr. Market has his next nervous breakdown and the economy enters a recession? That company will be insolvent. The intelligent investor looks for companies where debt is a modest and manageable tool, not a sword of Damocles hanging over the shareholder's head. The true margin of safety for the shareholder begins with a solid balance sheet. If the company's assets are worth $100 million and it only owes $10 million, there is a huge $90 million margin protecting the owner. If it owes $80 million, that margin is dangerously thin. The speculator ignores the balance sheet because he is focused on the next quarter. The investor studies it minutely, as he is focused on the next decade. Thus far, we have treated debt as a poison in the shareholder's cup or as the speculator's fuel. But for the intelligent investor, someone else's debt can be an extraordinary investment opportunity. I am speaking, of course, about buying bonds, not stocks, but the very obligations of a company or government. Here, again, the distinction between investor and speculator is crucial. The bond speculator does something very foolish. He tries to predict interest rates. He buys long-term bonds hoping that rates will fall, so the price of his bond will rise, and he can sell it for a small profit. He is, once again, betting on price movements, not on underlying value. The intelligent bond investor acts completely differently. He behaves like a private banker. He is lending his money, and his only concern is, will I be paid back in full, with the promised interest, and what is my protection if things go wrong? Most of the time, high-quality bonds, like those of the United States government or giant, stable corporations, do not offer a great opportunity. They offer safety, which is commendable, but they pay a modest interest. The margin of safety here is not in the price, but in the overwhelming ability of the debtor to pay. For the defensive investor, who seeks only to preserve his capital, this is sufficient. But, from time to time, our old friend Mr. Market offers us fascinating opportunities. Graham holds up the bond certificate. Mr. Market, in his manic-depressive state, does not limit himself to pricing stocks insanely. He does so with bonds as well. When he is panicking, he wants to own nothing but cash. He fears that all companies will go bankrupt. And, in this panic, he sells the obligations of perfectly viable companies for a fraction of their real value. This is where the enterprising investor finds his true opportunity. It is the only rational way to turn debt into money. Allow me to give you a classic example, drawn from my own experience during the dark years after 1929. Let us consider a railroad company. In the 20s, it was a giant. With the Depression, freight traffic fell drastically, and its profits plummeted. Mr. Market, looking at the dwindling profits, panicked. He took this railroad's bonds, which promised to pay $1,000 in 1950, and offered them on the open market for $400. The speculator sees $400 and thinks, this company is in trouble, profits are down, I'll stay away. The investor, the analyst, takes his pencil. He ignores the quote and goes to the balance sheet. He discovers the following. Interest coverage, yes, profits had fallen. But, even at these depressed levels, the company still earned enough to pay its interest expenses twice over. The coupon payment was not an immediate danger. Asset value, more importantly, he calculated the liquidation value of the railroad's assets. The tracks, the locomotives, the rail yards, the land. He found that, even sold at auction prices, the assets were worth $1,500 for every $1,000 bond. Now, look at the math. The investor buys for $400 a bond that gives him the contractual right to $1,000. His margin of safety is colossal. He has a $600 margin of safety in the price, $1,000 face value, $400 cost. He has an even larger margin of safety in the assets, $1,500 in assets to cover his $1,000 bond. What happens next? If the company simply survives, it doesn't need to thrive, just survive, the investor will receive his interest payments, which are very high relative to the $400 he paid, and, at maturity, he will receive $1,000. He has more than doubled his money. And if the worst happens and the company goes bankrupt? The investor, as a bondholder, has priority over the shareholders. He is the first to be paid from the sale of those $1,500 in assets. He will very likely receive his $1,000 back, or at worst, far more than the $400 he paid. He cannot lose. This, gentlemen, is value investing applied to the debt market. It is not a trick. It is the disciplined purchase of a financial asset for substantially less than it is worth, taking advantage of Mr. Market's irrational short-term panic. We have spent our class dissecting debt on a company's balance sheet and in an investor's portfolio. But I must now turn to the most insidious form of debt, and perhaps the most relevant to the ordinary citizen, personal debt. If turning debt into money is the speculator's motto, then consumer debt, the mortgage one can barely afford, the financed automobile, installment purchases, is its domestic manifestation. It is the application of leverage not to an income-producing asset, but to an income-consuming liability. I call excessive personal indebtedness a bankruptcy of the imagination. Why this term? Because living dependent on credit, with one's finances on the edge, requires the blind belief that the future will be identical to or better than the present. It requires the inability to imagine a setback. The person who owes next month's salary before even receiving it cannot imagine a sudden illness. He cannot imagine the loss of his job. He cannot imagine an economic crisis. She acts like the speculator of 1928, buying stocks on margin, believing the new era of prosperity would never end. The Great Depression was, above all, a lesson in the fallibility of human predictions. It taught my generation that adversity is not a possibility, but a certainty. The only variable is when and how it will arrive. The intelligent investor applies the same principles he uses to analyze a company to his own financial life. He sees his personal finances as a balance sheet. On the asset side, he has his house, if he has equity in it, his savings, and, most importantly, his ability to generate income, his job. On the liability side, he has his obligations, mortgage, loans, bills to pay. The difference between these two sides is his personal net worth. This is his personal margin of safety. The individual who goes into debt to consume, to buy a more expensive car than he needs, to take a vacation he cannot afford, is doing exactly what we criticized in Grocery B in Block 3. He is eroding his own margin of safety. He is increasing his fixed liabilities, while his asset, his income, remains volatile and uncertain. When the inevitable recession arrives, when the Mr. Market of the real economy, perhaps in the form of his employer, panics and cuts costs, this individual is annihilated. He loses his income-generating asset, the job, and his liabilities, the debts, remain. He is forced into bankruptcy or humiliation, exactly like the speculator forced to sell his stocks at the bottom. The investor, on the other hand, practices frugality. Not out of avarice, but out of prudence. He lives below his means. He sees his savings not as idle money, but as the purchase of the most valuable thing that exists, financial independence. When the investor saves 20% or 30% of his income, he is creating a personal margin of safety. He is giving himself the luxury of being able to say no. He can say no to a tyrannical boss. He can say no to the market's panic, as he does not need to sell his investments to pay the rent. He can withstand 6 months, a year, perhaps more, of adversity, without being forced to make disastrous decisions. Therefore, the question how to turn debt into money is fundamentally flawed. The investor's real question is, how do I turn my income into security? The answer is simple, though not easy, by minimizing your debts and maximizing your liquid assets. Personal debt is not leverage, it is servitude. And the first principle of a successful investor is to be a free man. In modern times, a new taxonomy has emerged. Finance professors and bankers, eager to encourage credit, have created a convenient distinction. They speak of bad debt versus good debt. Bad debt, they say, is what we just discussed in Block 5. It is consumer debt, used to buy depreciating liabilities, like automobiles or vacations. In this, they are correct. It is a financial poison. But then, they promote good debt. This, according to the theory, is debt used to buy assets, a mortgage for a house, a loan to finance a higher education, or leverage to buy a business or more stocks. The logic is that you are using borrowed capital to acquire something that, presumably, will appreciate in value or generate income, thereby paying off the debt itself and leaving a profit. I must admit, this distinction is intellectually seductive. And, without a doubt, it is preferable to borrow to buy a productive asset than to consume. He raises a warning forefinger. However, this idea is, in my opinion, one of the most dangerous traps for the financially imprudent individual. It gives a veneer of respectability to an inherently risky act. Good debt is only good under two strict conditions that are rarely met. The price paid for the asset must be correct. The ability to repay the debt must not depend on the appreciation or performance of that same asset. Allow me to illustrate with a parable from history. Consider two men in 1928, Mr. Impulsive and Mr. Calculating. Mr. Impulsive takes out a loan to buy a new, luxurious Duesenberg automobile. We all agree, this is bad debt. The car loses value the moment it leaves the dealership. Mr. Calculating, on the other hand, listens to his financial advisors. He takes out a substantial mortgage, a good debt, to buy a beautiful apartment building in New York. He also takes out a margin loan, another good debt, to buy a portfolio of blue-chip stocks, the blue chips of the time. He is not consuming, he is investing. Then, 1929 arrives. In 1930, 1931, 1932. Mr. Impulsive is in trouble. He owes money on a car that is now worth very little. But his debt is manageable. Mr. Calculating is ruined. Utterly annihilated. Why? Because he bought his assets at the peak of euphoria. Mr. Market offered him the apartment building and the stocks at inflated prices, and he accepted, financing this euphoria with debt. When the depression set in, the value of his apartments plummeted. Tenants could not pay the rent. But the mortgage did not shrink. The banker demanded his payment. Mr. Calculating lost the building. His stocks, bought on margin, suffered the very same fate we described in Block 2. The margin call decimated his portfolio. Mr. Calculating's good debt proved to be infinitely more destructive than Mr. Impulsive's bad debt. The fatal error is this: the speculator takes on debt based on the prediction that the asset's price will rise. The investor never does this. The investor analyzes the current intrinsic value and demands a margin of safety. If you buy an asset, a house, a stock, with debt, but you pay a price substantially below its intrinsic value, you have some protection. But if you pay fair value, or more, as most do in hot markets, your margin of safety is zero. The debt becomes an accelerator for disaster. For the investor, the only good debt is that on the balance sheet of a robust company, used for a specific and profitable purpose, and which still leaves the assets vastly exceeding the liabilities. For the individual, all debt is a fixed risk in an uncertain future. Treat it as such. The distinction between good and bad is, in practice, a distinction between a fast-acting poison and a slow-acting one. I prefer to avoid both. We have reached the end of our investigation. We started with a simple question, a question that encapsulates the spirit of our age: how to turn debt into money. I hope I have demonstrated that this is, fundamentally, the wrong question. It is the question of the speculator, the financial alchemist, the gambler seeking quick gains without considering the risk of total ruin. We saw how the speculator uses debt as leverage, a tool that enriches him quickly when he is right, but annihilates him, with mathematical certainty, when he is wrong. We saw how the margin call, the creditor's cry, turns a temporary paper loss into a permanent, real catastrophe. Debt, for him, is a chain that binds him to the whims of Mr. Market, forcing him to sell when panic is at its peak. In contrast, we define the investor's approach. The intelligent investor treats debt not as a tool for himself, but as a risk factor to be analyzed in others. First, he examines it on a company's balance sheet, demanding solid balance sheets and ample interest coverage. He knows that the shareholder's safety begins where the creditor's obligations end. He seeks companies that can survive the worst storm, not just navigate calm waters. Second, the enterprising investor may, on rare occasions of extreme panic, buy debt, in the form of bonds. But he only does so when it is offered at such an absurd discount to its face value and the assets securing it that his margin of safety is unquestionable. He is not predicting interest rates, he is acting as a prudent banker, buying a secure cash flow for pennies on the dollar. Finally, we addressed personal debt and the dangerous myth of good debt. We learned that all debt is a fixed obligation in an uncertain world. Living on the edge, whether to consume or to buy assets at inflated prices, is a bankruptcy of the imagination. It is betting that the future will be free of adversity, a bet that history, and certainly the Great Depression, has proven foolish. True wealth is not the ability to borrow, but the freedom not to need to. So, what is the correct answer? If the speculator's question is flawed, what is the investor's question? The investor does not ask how to turn debt into money. The investor asks, how can I allocate my capital so intelligently and safely that, regardless of what the future brings, my principal will be protected and I will earn an adequate return? The answer to this question is the sum of all we have taught. It is the meticulous analysis of intrinsic value. It is the discipline to buy only when there is a substantial margin of safety. It is the development of the temperament to see Mr. Market as a useful servant, not a master to be followed. And that brings me to our final commandment. He pauses, long and emphatic. In all my years, I have seen strategies come and go. I have seen new eras proclaimed and, invariably, end in tears. The only truth that remains is this: investment is not about beating the market. It is about surviving it. Your primary goal should not be to maximize returns, but rather, to minimize the probability of permanent loss. If you focus on that, the returns will take care of themselves. Therefore, my final commandment to you is this: do not confuse intelligence with leverage. Intelligence is your analysis and your judgment. Leverage, debt, is merely a multiplier of outcomes. And since no human being possesses perfect judgment, using a large multiplier on your decisions is simply an arrogant way of committing financial suicide. Be an investor, not a debtor. Build your financial fortress brick by brick, with your own capital. Let others play with fire. You, the intelligent investor, will remain solvent. And in the end, solvency is the only victory that matters. Thank you.